Hi, my name is Jeff, and I'm a day trader of U.S. options and equities. And I am here to talk to you today about my options strategy for reversals and bounces and gap fills. You can find me trading live every day in the daytradewarrior.com chat room, and I'll put a link at the bottom of this video so you can find me there every day. You can also follow me on Instagram, Twitter, or StockTwits at Income Traders, INCOMETRADERZ. Now, I've been receiving a lot of requests lately about my options trades. Anybody who follows me or who trades with me or seen me trade knows that I prefer to trade bounce and reversal plays. They're usually higher probability, better reward to risk ratios, and you can realize some pretty large multi-point moves at times. And they generally tend to be slower trending plays, easier to manage when you're in the trade. And so I've adapted an option strategy that capitalizes on some of the same concepts, and I'm going to talk a little bit about those today. This isn't an option education video. There's plenty of that on YouTube and everywhere else on the web. If you're not familiar with options at all, this video may not make much sense to you, but you need to check out Investopedia.com's resources, education resources for options, calls, puts, spreads, volatility, the Greeks, things like that. If you're not familiar with those terms, this video might not make much sense to you, but I'll put a list or I'll put a link at the bottom of this video so that you can find some resources to understand how options work. Now, the two main types of strategies I like to use options on are gap fills and dead cat bounces. A dead cat bounce is basically when it's a temporary recovery of prolonged decline or bear market, and it's followed by a small bounce or a small recovery in price, which then rolls over and the downtrend is continued. Dead cat bounces can happen for different reasons, fundamental, technical. After something's been in a decline for a while, shorts might start to cover and take profits, and other investors might be watching this temporary buying action in the stock price, and it might trigger them to enter a long position. And so what you get is a small bounce in price, followed by continuation of the downtrend. So it's a temporary reversal in the price. And the other type of option strategy I like to use or I like to trade is gap fills. And a gap fill, gap can occur for a number of reasons. It can be fundamental, technical, good earnings. Oftentimes earnings are a huge catalyst. Earnings and news are the two biggest catalysts for gaps, I would say. You have a stock that puts out really good earnings and great guidance after hours one day, and the next day it opens up $10 higher than where it was trading before the earnings report. So a gap fill happens when the stock price, after the gap occurs, the stock price moves to fill the gap to where the price of that stock was previously trading. So it's filling the gap between the old price and the new price, and that can happen because of profit taking and other fundamental technical reasons. Over exuberance. A lot of times, if something gaps up, people want to take profits, and maybe other people will evaluate the news and the earnings and realize they're over exuberant in their in their evaluation of the price, and so therefore sellers come in and the price normalizes. Or it comes back down to where it was trading before that gap, and it fills it. So I look for options that can capitalize on these two very basic and very predictable movements. Now, first thing I do every morning is I check my gap scanner in the Trade Ideas Pro platform that I use. And every day there's different stocks gapping up or down for various reasons. They tend to, I sort these gaps by volume, by the dollar change and the percentage change, and I evaluate, a handful of the biggest ones or the ones with the biggest price moves every day. And so once I've evaluated, a stock that's moved up on good earnings or gapped down on bad earnings, The next thing I do after that is I go into the options chain, and I look for stocks that do trade options, because not all stocks will trade options, and I look for ones that are liquid. Liquidity is extremely important in options trading. If you can't get in or out of a trade, even though you have huge potential for return, and you're maximizing the trade with a bunch of leverage, it doesn't do you any good if you have nobody to sell your options contract to, or buy your contract, enter the position. So you have to have liquidity in the options. So for that, we check open interest and trading volume for the past few days, just to make sure there's enough interest that if we get in the trade, we can get back out safely. When I trade, I really have no interest in owning the underlying stock, so I never hold through expiration. I never exercise my options to own the stock. I'm only trading the premiums. It's a swing trade for the most part when I alert these, so it can be held anywhere from one day to multiple days or weeks. Usually the moves that occur, I'm in and out fairly quickly. I look to take profit between 50 and 90%. And so once the premiums reach those levels, I'll evaluate the trade. And sometimes I'm out of the trade the same day. And we're going to talk about one today that I traded on Friday for about 150% winner. And I'll talk to you why I like the trade, and also why it was profitable, and how I went about selecting it. So the way that I select these trades, I identify SLXP. It was the trade on Friday, Salix Pharmaceuticals. They gapped down on news. It was, at the time, I don't know, about $70, $80, $60, $70 gap, something like that. I don't know. It was huge. And I know I've traded SLXP in the past. It had a short sale restriction on it, which means that it would have been harder for shorts to continue to pound the stock to the downside. And so there was a likely chance that it would bounce or would fill part of the gap that it would put in a bottom. And there's always a chance that it just continues selling. But the more extreme the move, I think, in my experience, the more likely the bounce or gap fill will occur. And so I traded based on those parameters, and I select my options. I select my strike price for options based after the opening range, the 15-minute opening range. So I pull up a 5-minute chart and I watch the price action for the first 15 minutes of the market. Now, the first 15-30 minutes of the market tend to be the most volatile. It's usually when there's the most volume being traded in the day, and it's going to be the time period that the opening range is established, both high and low, for any stock. And so I don't want to buy these options right at the open, because I don't know when the rest of the retail investors start trading it at the bell that it's not going to sell off even more. And so I wait for that 15-minute range to be established, and then I begin to look for the strike that I want to buy my option at. Now, on Salix Pharmaceuticals, they traded, I believe, in $5 increments for their strike. So the stock was trading around $86, $87. And I figured that it was going to make some attempt to fill the gap, or to bounce, or to move to the upside at some point during the day. Now, we've had somewhat of a bull market the past few days. The move to the downside on SLXP was fairly extreme. So we had that in our favor. It was extremely oversold. And after the 15-minute range had been established, there wasn't much, there's only a few dollars movement in price. So it appeared to me that the sellers weren't going to continue to pound the stock. And so I went and found the next closest to being in the money strike price that I could find. And I do this on every single options play that I can find. I always choose my option strikes with an expiration of at least 3 weeks, preferably a month away. And I always look for the next closest strike to the actual price. I don't buy in the money options. I buy at the money or just out of the money, and I get the best returns following that strategy. So I bought the $90 calls, December calls, monthlies on SLXP, and it was about a 4 or 5 hour hold, and the stock finally started its move back up, and we ended up getting to about $96 on the day, maybe 97, and it was $96. And so by that time, I was already $6 into the money based on my strike of 90, and my delta is a lot more favorable. And as the stock is putting in a bounce while my options have come into the money, the volatility increases, which helps my premium price increase, which means that my gains will be realized quicker than if I was out of the money. And so when a stock price has an extreme move in one direction, the direction of that option is going to have the most volatility. For example, when SLXP drops $50, $60, the put premium is going to be through the roof. If you're a put holder before that drop, congratulations, you made a ton of money. However, in order for the put premium and the volatility to be to the downside in the stock, that means that the call premium or the long bias for the options are going to be super cheap. The volatility gets sucked out of the long side because of the downward price, the extreme downward price action of the stock. So that makes the calls super cheap. Now, if you're holding those calls before the stock took its $50, $60 dip, then you're going to be hurting. But we use that opportunity to buy when they're super cheap, and we buy them just outside of the money when any little reversal in price action is going to pull some of that volatility out of the puts and put it into the call side, which will help us increase our premium value rather quickly. So I waited for the opening range to be established on SLXP, and once that was done, I found the $90 calls. There was plenty of open interest. They had already traded some volume on the day, a couple hundred shares at that time, and I ended up buying the 90 calls. And I held it for the day, and I ended up selling twice. I sold one half at 100%, and I sold the other half just under 150%. So it ended up being about a $1,700 winner, and only on a few contracts. And it was a perfect example and execution of the gap fill strategy here. And this is more of a combination of a gap fill and a bounce because of the extreme movement. Everything kind of went in our favor. And by buying the calls when they were super cheap and super undervalued, and when all the volatility, which is part of the premium pricing for options, when all the volatility was into the put side after it's moved down, once it started and confirmed a reversal and a move up, we were able to capitalize on that quick volatility spike in the call side, as well as the price action when we were in the money, and it made for a nice, quick, profitable trade. Now, there's a chance that SLXP could continue moving to the upside and could become a complete gap fill all the way from its base here around $86, $86, all the way back up to the 130 that it was trading at before it gapped down. We're not investors in this stock. We're not looking for that move. It would be a huge move. I don't know that it will get there by December based on the news that caused the stock to drop. I don't think that is very likely. I don't like holding over the weekend because of the exposure to news and other catalysts that can hurt your position. So I opted, while I believe there's more upside to this trade, I did opt to take my profits at the time because I just don't like leaving a ton of money on the table. And I can always get back into this trade if something changes and I feel like it's going to be a long-term investment that I want to take. But generally with options, you need to take your profits when you have them. Options aren't, when you're buying options, they, if you've ever traded options before, you know that you can be holding an option in the money, the price can be moving up, but you can be losing money on the options. So you have time decay working against you, and volatility, market volatility. You have so many things that that you have to overcome in order to be profitable. So when we're trading these strategies, we like to get our money out of the market as soon as possible, as soon as we have it. And I found that using the strategy, I'm able to more times than not get out of the trade with money that I didn't have before, and that's what I consider a success. I'm going to post the links for the places you can find education on this type of strategy. Also, you can find more information on how to trade options, and that'll explain the volatility and premium pricing a little bit better. And now that you know what I look for, if you have any questions, you can post them to this video channel, or you can message me, or you can find me in chat, and I will be more than happy to go into more detail. I would pull up an options chain and show you what I look at. However, Interactive Brokers is doing maintenance this weekend, and I'm unable to log in to my account. So that'll have to wait for some other time. But if you have any questions, feel free to ask me. You can find me at daytradewarrior.com, trading every day. I alert these trades a few times a week. I always try to cherry pick the best possible setups, just because options do generally involve a lot more risk, and I try to maximize, try to control my risk, manage my risk, and maximize my gains. So once again, thank you for listening to this video. I hope it helped answer some questions about what I look for and how this strategy works when compared to a regular intraday trade of a bounce. We're looking at longer time frames here. We're looking for more extreme moves, and we even traded this bounce, or we could have traded this same bounce in chat intraday using the stock, but using leverage, in this situation, and time to our advantage. Now, granted, this trade panned out in a few hours for us intraday, but we made probably more money trading options on this than we would have made trading the stock. So that's just kind of the power that options have. Once again, they are super risky. If you're not familiar with them, please use the education links I post at the bottom of this to familiarize yourself with them. And if you have any questions about my trades or why I chose what I chose, then never hesitate to ask. Thank you.